Hey everyone, welcome back. My name's Levi. This is Drawbridge Finance. It is Tuesday, March 3rd. This is my public live stream, which I love to do. It's my favorite time of the week because I get to join you guys, talk about options, talk about trades, and we get to see exactly what's going on in the market. We can set up some potential trades. And as always, not financial advice in any way, shape, or form. It's just what I'm doing, what I'm looking at. So I hope you guys are having an awesome trading week. I'm going to point out that you can see my sign is green today. When my sign is green, it means that my account is up. Now, that may be a shock to some of you because typically when we're in a position where we're long stock, when the market is down like it is today, most people's portfolios are red. But I don't trade this way. I trade in a very delta neutral way, and I often have a profit tent that is wider than the current market's expectation, and I often have quite a bit of downside protection on. So I'm going to show you a couple trades today, a couple of setups that I have on, and why my account might be green in days like today, and we're going to take a look at that. I also want to help you guys by showing you how I might set up new trades when I'm looking at potential whatever the stock is. It doesn't matter what the underlying is. We can look at futures. We can look at individual stocks. Now, I primarily play individual stocks. I love to play the indexes. I don't do a huge amount of futures trading, but I do from time to time. And we're going to talk about that today because obviously with the war in Iran going on, we've got gold going down a little bit today, but oil going up and putting a lot of pressure on that. US dollar going up today, so that is moving a bit of the market around a little bit. I do this by myself, so if one of you could let me know if I'm working, that would be fantastic. It's always good to know that I'm not just talking to myself out here. So I see that there's a couple people online, and I have a couple of likes already, which is fantastic. Thank you so much. But if somebody could let me just know in the chat window if I'm working correctly, and also what tickers you want me to talk about, because I don't have a script for these. I just go with what you give me for input. So I'll stay here as long as you guys want me to kind of stick around and play. We are going to take a look right now at the indexes just to kind of give a little overview of what's going on. So SPX today, you can see this huge wick down the bottom. We're actually slightly negative on the day, down 0.8% as of right now. But earlier today, we were down much lower. We're outside of those Bollinger Bands. We're away from the point of control, which is up here for the recent trading action. And you can see this price action came down and then came back up. We're going to see a very similar reaction on NQ. And this is partly because the majority of the NASDAQ 100 and the S&P 500 are clustered in a handful of stocks. There's the Magnificent Seven, about 10 stocks control the majority of the value of the S&P 500 and the NASDAQ 100. So both of these are highly correlated at about a 91% correlation most of the time. We can see that same action here where we see this long wick a little bit closer in these Bollinger Bands, which means there's a little more volatility typically expected in the NQ in general. We'll see the Russell down the most today, down earlier almost 3%, now down only 1.2%, but this is partially a rotation of money moving out of these small caps and moving into places like oil. Before we get over to oil, I'm going to talk about the VIX. We saw a large candle. We were trading up above 28 earlier today. So the VIX is very high. We've had some elevation for the last little while. This is nice. This is when we put in a high premium type trades. Now, if you're not sure what a high premium type trade might be, this is where we play like short strangles, where we're just selling premium. That's it. Or defined risk trades like iron condors. The reason that we play these in high volatility is because, in high implied volatility is because typically the movement of the stock is actually less than the implied potential volatility that is there. So that is what we're looking for. We're looking for when that implied volatility gets high. That's the IV. When the IV gets high, we want to put on premium selling strategies, and this is where we deploy a little more capital. As of late, we've had quite a bit of elevated IV. So for somebody like myself, I am deploying more and more capital all the time because this is a time frame when I can do that. Let's look at oil quickly. We're up 5% today. These big spikes. We saw the move after the weekend's events. Saw the move up. Yesterday, we're seeing another gain today. So yesterday was a big move and then kind of pulled back. Today we opened and are pushing higher. So we were higher even yet. We were up at about $78 a barrel, but currently trading at 74.72. Gold pulling back. The money has to flow from somewhere. We can't just have the markets be up, up, up on all fronts. So typically when oil's been pushing up, that money moves from gold to oil, if that makes sense. Silver down only 6.42%, was down almost 10% earlier today. But again, we're seeing a little bit of recovery, a little bit of normalcy. Before we get too much further, I do want to talk about the Drawbridge Traders Club and how my members actually are making money. Now, last year I implemented the Drawbridge Finance AI stock picks, and today we broke kind of a milestone. It's crazy. Since I started this last May 1st was my first alert. The portfolio has returned a 40.5% return cumulatively. So it has outperformed the S&P 500 considerably. Now, the idea with this was for my own trading. What I wanted to do was get myself away from the computer, and I wanted to have a portfolio that required a little less than my options do. My options, I typically have positions on where I'm like at least looking at them daily on almost every position. And I have about 70 positions on right now. I can have up to 100 at any given time. So this requires a little bit of work. I have to sit down at the computer, and I spend somewhere between half an hour and an hour and a half every single day, kind of just going through and just checking and making sure that the positions are in an appropriate place. Now, you get pretty quick at it, and if I didn't have 70 positions on, if I had a more reasonable amount, if I wasn't an educator, but if I had a more reasonable amount of a core position between like 15 and 30, this would take me somewhere between 15 and 30 minutes a day, which I think is fantastic as an active options trader. But what I wanted to do was add some money, some portion of my portfolio into a strategy that required very, very little effort. And my goal was to create a system that I only had to trade 30 minutes a month. And what I did was I came up with this very, very simplified strategy, which was to deploy a weighted amount of capital across a basket of stocks. Now, this month, I think I have 26 stocks on, 25 or 26. I can tell you exactly. Can I tell you exactly? I have, no, I can't tell you exactly. No, I don't have the screen open right now. But again, I only trade this once per month. So yesterday was the trading date. And then what this does here on my website is it actually tracks these returns real time. So you can see in here, you can hover over, and this is a live chart. It updates daily. So this is the return as of March 3rd, which is today. And yesterday, the portfolio that I purchased is already up 0.91%. Now you can see the S&P 500 is down 0.71% over that same time frame from yesterday's close till this morning. I have beat this portfolio has beat the S&P 500 now 9 out of 11 months. It's at an 81% outperformance rate. And this is exactly what I'm trying to do. You know, I've been trading now. This is my 30th year trading. And I am, you know, like, there's a few things that I've learned over the years. And there's sometimes that I'm just like, I just want something simple that I can only adjust once per month. So that's why I came up with that. If you guys are interested in checking that out, you can see all of my option trades or some of the option trade results that we're having, all the descriptions about the Traders Club, a little bit about me, and you can join that. You can join it monthly. And I've got a new ability to do that through wap.com. So you can get an annual subscription for up to 50% off, which is amazing. And I also have lifetime memberships available as well. So it depends on what you want. If you want to just try it out for a month, you're more than welcome. I offer that kind of thing. I don't really like services where people are offering the whole gamut. Like, you know, I pay $3,000 to join my club because, well, what if you don't like it? You know, what if you want to join for a month? Check it out. Well, that's why I do it for as little as a single month. And I give you all my resources, everything in Discord, all the downloads, everything happens that very first month. So it's a pretty amazing deal. If you haven't considered signing up for it yet, you should think about it. What else are we going to look at today? We're going to look at, we're just talking about the market. I'll show you kind of the dashboard on Moomoo. I love Moomoo's dashboard. You can see some of the global things that were happening. We said Japan down 3%, Taiwan down 2%, Shanghai 1.4%, Italy was down almost 4%, Germany down 3.4%. So we're actually doing pretty well, all things considered. And you can see this dip that we saw, and now the current price coming up. Yeah. So we can see crude, gold, silver, all of those fun things. Let's get into some questions, and I hope you guys have some questions. Frank says you're working so well. Corey says you're good. Thank you so much. I appreciate it. Kevin, happy birthday. That's amazing. Thank you, Kevin. You have been a watcher for so long. For years, you've been joining my Tuesday live stream. So I very much appreciate your support. And Low Rip says, happy birthday. You guys are amazing. 4 years of trading and still not consistently profitable. That is not good. Well, are there strategies that you feel you're missing out on? Maybe we can discuss those. I want to show you some of the things that I've been putting on very recently. I've got some saved trades up here from, this is an option strat. And you'll see some of these trades in particular and how much they can gain. So if we were to we'll take a look at some of these, but in general, the potential gains are massive. If you look at like just today's return on some of these calendar spreads, 84% return on capital. I made $640. Now these are relatively low risk trades. Let's take a look at one of these in particular. This one I labeled as a hedge. I entered it February 6th because we assume that we're going to get into a period of volatility when the markets are kind of at that top kind of bubbly shape that we see. And I've talked about that on a couple of these live streams. So when we get into these positions, what I will do is I will set up a trade that has a relatively large range, and it has a relatively low risk for what it is. Like this trade, there's a net debit of $880, and it is returned. So that was a net debit. The max loss was 2,000. So we have to kind of compare what it is that we're looking at, how much we're risking, how much we're paying, and how much the potential profit is, and where we are in this particular case. So on a trade like this, relatively simplistic. All I did was I sold some puts on March 6th, and then I bought the same strike put on March 9th. These are just 3 days apart. And when we do these about a month ahead of time, we get a profit tent that is relatively large. And if the volatility increases, as it has, then these tents get even larger. So this was very specifically a trade that would take advantage of implied volatility increasing. Now I paid $880 for it, but the more important thing is how much was I risking at the time. Now the risk was $2,047, and now the max profit is up to $5,000. And these trades, my intent is to stay into them for a long time, as long as they're growing within the tent. So if we look at this, if we see this dotted line right here, there's 3 vertical lines on here. These indicate 3 different things that are very important to me. The first one is this white dotted line. That is where the S&P 500 is trading right now. We see this SPX 6825. That is represented by this white line in the middle. Now, the next most important thing to me is the break even. Where is the break even? Well, it's $7,037. Now, I know that the S&P 500 would have to go up 200 points in order for this to be breached on the top side. And I can also see that the tent, the dotted green tent, is higher than my single solid line in here. These are also important things for me to recognize, because as time passes, these are dynamic, which means they change. They change based on IV change, and they change based on where the underlying is relative to the break-even points. So from right now, from today, my lower break-even is 64.85, and my upper break-even is 70.37, and we can see SPX is trading at 68.25. This is ideal for me. This is where I want it to be. I have a larger move to the downside that can be cushioned. I have 2 nice profit tents at expiration if I chose to hold them that long. And I have a little bit of a profit tent above. My curved line, which is my gain today, if the market was to move. This is how much would my account would change today. That's this solid green line. We're right exactly where I want to be. This kind of more cushion to the downside. Now, as I slide along in time, and the option strat makes this really easy, you're going to watch what happens to my solid line. So right now, I'm at a profit of $1,244. I couldn't be at a better place. This is where the best profit is. I actually designed this trade for this potential of it moving down. That's why I'm showing you this one, because we're right at the peak. Now, as I slide along, you're gonna watch my break even on the downside is moving over. You see this blue line is moving further. It's getting more and more safety in place. And this, the height of my tent, my solid tent is actually getting higher, and it's going to peak out around this kind of darker dotted line. And at that point, that's when I'm likely going to want to close this trade. So at this point, my break even's moving, I'm moving, my profits are getting more and more each day. And if I slide this all the way along, you'll actually see that I get to a place where I make bigger profit, and then it will go back down. It'll actually shrink back down. But again, it depends on where we are, and this is where it's dynamic. So if I am in a position where in 1.5 days from now, which is getting pretty close, in 1.5 days from now, the market is still exactly where I am, where we're sitting right now at 68.25, then I might consider closing this trade, because if the market moves down, I'm losing money. This slope is down. But if it already has moved down, I may consider to keep it on a little bit. Now, I don't want to hold these right to expiration. There is always this little bit of gamma risk at the end. And I know that last little confirmation that where the last couple of hours, so this would be Friday at 6 in the morning market time opening, we would, the tent looks like that. And by end of day, it looks like the full confirmation of the trade. I will not hold it that long. I will likely be out of this trade by end of day Thursday. So wherever we are. In this particular trade, end of day Thursday, I actually want the market to be down. I would like the market to be 100 points lower than it is. This is why I'm playing these types of trades. If it doesn't, then this trade, if it just stays where it is, I'm gonna make another $1,300 on the trade. This is a hedge as well, which means my hedge is making money if my account is not making money. My account has a different type of slope to it. So it has a profit tent that looks, a little bit more to the upside. And what this does is it allows me to have hedges that are making money if the market is complacent, and then my standard positions, which are long stock positions, will make money if the market goes up. So that's kind of how those kind of function together. And we'll just go back to some of these safe trades, and you can see these are all like, this one is $1,200. This one has made this very, very similar setup, a little bit simpler in position, but it only has 2 little tents. And this one's already in a place where the profit tent to the downside is actually higher, but it also has a higher break even at 65.79. So again, looking for this particular range on this trade. Let's go back and we'll look at another one. Now, these are all trades that I posted in my trading group. So when I post these, people have the ability to assess the trade and say, okay, is this a good trade for me to take? And take. And again, like, where are we today? The slope is actually, this trade would benefit from a move up. See the slope here on this solid line. The peak would be, this trade today would be worth $722 if the market went up to 69.33. So it would require a 100 point move to the upside to be at max profit, but it's still profitable. I mean, it's still made $450. This is not a terrible trade at all. These are profitable trades. Max lost $1,300 when I put it on. Obviously, it has made some money now, so there's a little bit more risk of it going down. Terry's watching from Clairehome, Alberta. You guys are amazing. I appreciate it very much. Now, is there anybody in the chat that's actually trading diagonals like this? Are you guys taking these types of trades? Let me know in the chat window. Type yes if you're taking this type of trade. Type no if you don't know how this type of trade works, or if you want more clarity on it, or if you want me to go over an example. Maybe what we can do is we can do a live example today of how I might set this up. So let's just look at let's just look at it. We'll look at a double diagonal. Now it shows here as in these other, but double diagonal is like one of the better trades that I think that we can play once we get into dynamic trading, and maybe not the best for high IV environments. Double diagonals actually love IV increase, which is part of the reason why these are so profitable this week. So it may be something to look at today, but maybe not something that we might want to put on. So let's look at the queues and see what this looks like. So by default, it's just pulling up some trades. We've got expirations happening on March 13th. That'll be the short positions, which are underneath the line. This indicates that this is a short 598 put that expires March 13th. This is the short 608 call that expires March 13th. Then there's a long 613 call that expires March 20th. And then there's a long 593 put that expires March 20th. So this is a diagonal. Most of the time, if you want like the cheapest, the biggest bang for your buck, if we look at this setup, the max loss is 638 bucks. So we're looking at this, and the max profit is 732. Now I want to show you how we can make this an asymmetrical trade. And if we play a calendar, calendars typically have a smaller max loss and a larger max gain. Now in this case, it actually doesn't. We're looking at this. This is actually a worse type of setup. We have a max loss of 533 and a max profit of 467. So we're not even able to make back the amount of money that we're risking, which is not good. I want to make at least 1-to-1, but preferably I want to make even higher than that. So one of the things we can do is we can move these strikes a little bit closer together. So if this is March 13th, what if I was to move the 20th to the 17th? So I'm just going to move those over and see what we get here. So now the max loss is 349 compared to the max profit of 575. Now this is 10 days out. What I might want to do is I just want to move all of these. Let's see if we can do slightly longer expiration, 14 days to expiration and 24 days. Again, we're looking at max loss of 900, max profit of 568. Don't love that. It's also moved my strikes over a little here. So let's center these up again as calendars. We'll go to a position here where we've got max profit of 518, max loss of 652. Again, tightening these in dates, having them a tighter date typically will increase the amount of max profit relative to the max loss. In this case, the max profit is still negative. I don't love this. Now the break-evens are between 589 and 619. This is a pretty wide range. This is the Qs, which are moving right now around $10 today, $10 per day. Today down, what is it showing there? It's so hard to read on the screen. $5.34 moved down, but we were much further than that. We were another $5 lower earlier today. So is there going to be a range where we have, a $30 move over the course of the next 14 days? It's very, very possible. So we have to be a little bit strategic about how we play these. Now, if we want direction in one way or the other, all we have to do is adjust our positions accordingly. So I can extend this range out. If I think that the NASDAQ is going to move, 16%, then obviously I wouldn't trade something quite so tight. What I might do is I would just move these all over, and I would look and say, okay, well, what if I traded something that was much more extreme? As we get further out with these, there's a double diagonal has what's called a saddle. And that is the shape that we're seeing that's between the 2 points. This is a saddle shape. Now, I have been trading these quite a long time, and I prefer to trade trades that have a shallow saddle, okay? So that is something that I'm looking for. In this particular case, when we start the trade, we can see where our break-evens are. They're right at 602.90 and they're at 636. And 602.90 happens to be right where the stock is trading, which means that if the stock moves down, or the underlying moves down, QQQ moves down, it is instantly a losing trade. Now, max loss on this is relatively small. I mean, it's a max loss of $221. So these can be extremely small trades, but I don't love that. And I don't love that there's a, profit, this isn't neutral. I want to start kind of neutral. I want my stock to be in the middle of the range. So I can adjust these in a couple ways. I can move the calls over, or I can move the puts over. Now, or I can increase the number of puts that I have. And you'll see that very first example, one of the things I did was I had 3 spikes on here. And this is where I typically start to set up things like this, where I'm looking at it and saying, okay, this is short delta. This has a very, very small profit window at this point. Max loss of 280 bucks, max profit of 367, but only if the stock trades exactly at 570. Can I add some positions? So let me just add some in here. I'm going to add a long put on top, and I'm going to add a short put as well. And it is option strat is automatically going to put those on whatever date I have selected. So this is going to be March 17th, March 17th, March 17th. They kind of pop this long and short in here. I'm going to change the expiration date here to the 20th so that I now have a profit. Sorry, I have 3 calendars. And you can see what this has done. It's created a rather large saddle here in between these strikes, but then it's created a slightly shallower saddle in this space. These saddles are deep right now, and partially because of the increased IV. But when we get into this three calendar construction of a trade, what I'm looking for is not necessarily these peaks, but what I'm looking for is what happens if the stock moves right now. In this case, well, it would follow this solid line that we're seeing. I know there's multiple lines charted on here, but this solid line. So right now, the break even is $5.95. It's $7 lower than the current price. So this has a nice little range if I wanted to get some short deltas. When I say I want short deltas, I want a position that makes money when the market goes down. If time passes, what happens? Does this trade grow? And you can see that solid green line is increasing. So these are ways where we can put on trades that make money to the downside. Now, the cool thing about this is the implied volatility. Now, the reason that the trades that I'm in right now have made money is because the implied volatility expanded. When I put them on, the implied volatility was lower. If I slide this down, which is what the expectation is, these trades will lose. When we're in a high IV environment and the expectation, I'm just going to go back to the VIX for a second. We're going to go look at the VIX because I want to show you what happens to the VIX. VIX is one of the few mean reverting indexes out there or products out there. So when we see a high VIX, and high meaning anything above 17, which is this red line. So anytime that we see a spike, so we see the increased volatility back just before the end of November, and when the VIX gets high, it comes down relatively quickly. And we are seeing that set up right now. So we see 1, 2 days where we have high IV. Now, if it continues to go higher, it could go way higher. In COVID, it hit 80. But this is expecting a 28% move in the market as of this morning. This is high VIX. You know, when you look historically, like if you pull out over time, aside from COVID, there are very few instances. There is entire years. If you look back at 2017, the whole year was under 17 VIX. And then we have these events that occur. And when they occur, this was COVID. You see how big it is. And then there was lots of volatility in 2020 and continued into 2021. But we're not in that environment right now. In 2024, it was relatively low VIX, and we're waiting for these bigger spikes. So we have to take this opportunity. And you can see over the last year, if we look just back from June, so this is April of 25, we saw a large move up to 60 VIX. But typically, VIX spikes, like these wars that are breaking out right now, this is the range that they get. This is it. And we only get these opportunities a couple times a year. So since last April, this is our 4th opportunity of a VIX this high. This is when we put in short volatility plays. We do not start double diagonals. The trades that I started yesterday, before the volatility was really exploding the upside, were fine. But once we hit that major marker, and we see that wicking come down, the candle wick come down, our assumption is that things are going to settle out from here. We know what's going on in the Middle East right now. As the news filters out, this volatility, the implied volatility, will decrease. This is a given. Now, we don't know if the market's going to go up, or we don't know if the market's going to go down. We don't know if oil is going to go up or down. But what we do know is that the implied volatility will fall eventually, unless there's new things that occur. So if the war gets worse, then the implied volatility goes higher. But if it stays where it is now, and then as time passes, the VIX drops. So that's why we're trading trades today that are high IV trades, and not that setup that I just showed you. The double diagonal is not a good play because the implied volatility right here is 25.8%. It's far too high for these types of trades. Low rip. How is your loss larger than your debit? Well, because there can be spreads on these. So in this case, the debit's 432, the max loss is 432. When we get to a position, like say that at expiration, the implied volatility is higher, then there could actually be a situation where we have to, we aren't able, so if the implied volatility has dropped, we aren't able to recoup as much as we've paid for the trade, if that makes sense. So we can lose more in the longs and they can just have like a zero value. In order for there to be a larger loss than the debit with a spread like this, they have to be diagonals. So if you notice right here, net debit's 432, max loss is 432. As soon as I change this to a diagonal, now this position has $500 of risk more than sorry, that I went the wrong way. If I go this way, then the net debit is only 189. The max loss is 668. And this is because the short call is inside of the long call. So if there's a spread like this way, if the short put is inside, then there's $500 of risk here. There's $500 worth of risk here. That $500 gets added to the net debit. So the net debit is 119 plus 500, 619. Now, if I do the same thing on this one, if I add another 500, this max loss is going to increase by another $500, and my net debit is going to, let me just move that over. My net debit is going to decrease. So now the max loss is $988. And these are all valid setups, if that makes sense. Does that make sense? I hope it does. I buy longer dated puts and sell shorter dated puts against it. I buy a month out usually. Yeah, and how low rip, how short are your, how short duration are your short dated puts? Any thoughts on Hood? Easy money. Let's take a look at Hood. I'm going to look at, we're going to look over at investing.com. Just look at valuation and movement. So we'll look at the days change. Price right now is $76.50. Day change $2.30, down 2.92. Fair value is at 51.26, downside of 33%. We have a whole bunch of red bearish signals here. The financial health is actually pretty good. They're profitable. They have good growth. They have, a medium cash flow in here. And let me just turn myself off so we can see here. The relative value is where we're kind of dying in there. So is it overinflated? And if we were to look at the chart, we can probably see that over the last year, it's up 63%. So that is where, it just may have too high a valuation. Last year it was trading at $43. This is much closer to the fair market value. Now it doesn't mean that this is going to go down. It just means that from a numbers perspective, from a quantifiable perspective, the fair value to pay for Hood right now is around $51. Typically, I watch this quite closely because I think that this when we get in a trend and when we see the trend to the upside, that's fine. But when we're in a downtrend, I don't want to get too long these positions without some sort of option trading on top of it. And you sell a week out, low rip, Lori. Oh, hi, Lori. Sorry. Yeah, it's low rip. Of course, it's Lori. Thanks for clarifying. I'm just like reading everybody's name. Yeah, of course, Lori. So you're selling a week out and you're buying a month out. With those types of setups, it can be tough. Are you doing them as diagonals or calendars? One of the things that this doesn't show. Let me demonstrate it in Moomoo because you'll see you'll see the theta decay. But if we were to look at Hood on the options chain and we were to go out a week here, March 13th, and say we were going to sell, is there earnings coming up on Hood? Wow, there's a lot of premium in here. So let's clear that off. So say we were to sell the 70 put and we were going to sell the, so much premium, 85 calls. Are you doing just puts? I buy longer dated puts and sell shorter dated puts. Okay, that's all you're doing. You're just doing the put spreads. Okay, so let me clear this off, and then we'll let me attach this so we can see what's going on. We'll get rid of the calls altogether. I like to trade these as double-sided, but so here's the 9 days, and we'll go out 30 days. So April 2nd. And if we do it as a calendar, which means both the short and the long are the same, what does the equity curve look like? You know, these are relatively good on paper. We see an expiration P&L, if it was to go down to 70, of $272. And so our max profit is 275, our max loss is 196. But the probability of profit is only 51%. One of the things we have to look for is whether or not the theta is positive or not. Is there earnings coming up on this? I hate to do it on individual stocks, especially in earnings season if there's none posted here, but it's a lot of premium. Wow. You know, these are 51% probability of profit of trades, and they're pretty slow. They're pretty slow moving. They can be quite good if the stock moves right to the expiration P&L. But similarly to option strat, we can kind of see what the curve looks like. This one doesn't show the break evens moving over. But we do see the break even here at 78.18, and you can see that dotted line March 9th. So if we were, you know, at expiration, that's where that 78.14 is going to play. Are you carrying these right to expiration, or are you getting out of them? These are directional trades when we sell below. We can increase the amount of probability by just moving our shorts over a little bit closer. If we move the short over to, like, say 71 or 72, this widens out our break even. You see our break even now is 80, but it increases the amount of risk that we have on the downside. So the max profit's 238, max loss is 346. You can see those down here. So very similar to option strat, but the probability of profit's only 48%. These are binary event type things. Doing it as a double diagonal definitely increases the chance of winning. The other thing that we can do is just sell one naked put, especially when there's so much premium in here. If I'm doing this type of setup, what I do is I often will add some risk. So I will take one extra short put, but I'll make sure that I'm selling enough, a big enough ratio. So this might be like a 6x5. And when we do that, you know, my max loss is quite big. Now, my max loss is that I would end up owning shares of hood, right? So I could end up having a max loss of up to 7,800. So it's a much bigger account portion, but the max profit is 1465. And we can see that this theta will be much higher. The theta decay on this, instead of being $6 a day per one contract, now we're getting 5 days, you know, five contracts expiring, and that's $6 plus one of the shorts is losing value quite quickly because it's naked. You're not paying any theta decay on the long because there isn't a long there. So that is one way that I like to look at these. The other thing with this is if IV increases, you'll see that tent widens out. Now IV typically decreases if the stock goes up, which moves your break even in. So if you're buying this, if you're doing this type of position, if this is what you're looking at, and the stock is continuing to move up all the time, then the IV will constantly be dragging down, and then the setup isn't that great. One of the things you can do to combat that is to do the longs at a much later date. You know, get the longs at greater than 100 days. So like this, the June 18th, which are 106 days, the theta decay will be much, much less. Let me just go down to a one contract again. Remember, we were at $1 or $6 theta decay on this. This theta decay now is $9.80 instead of that $6 and some change. So almost 50% more theta decay by playing the longer put. Of course, the max loss is greater. We're putting more capital into the trade. So in a large move, this can hurt. But on a daily basis, this actually generates more money daily. Over the next 9 days, it generates it a little bit faster. So if I am going to play something like this, I want to enter these when the stock is moving down, like a day like today. I would want to look for IV that hasn't expanded all that much, and I would be looking for a longer dated put. And I would not really consider doing like a 9 and a 20 or sorry, a 9 and a 30, but I would be much more consider like the 9 and 106. And then I would close this at the end of the week. And then I would open my next 7-day with the next strike out. So that would be, next week I would play the July, and I would be able to play that July long contract for 3 weeks in a row until it gets to 100 days. As soon as I'm under 100 days, I don't really want to own the longs because the decay is too big, if that makes sense. That's for me. That's what I've done. I have found that to be successful. Put a little more cash into the trade and have that increased daily theta decay. Corey, I bought Vail around $15.63 and Rig around $6 this morning for a swing trade. I'm looking to hold anywhere between 3 days to 3 weeks. If I were to trade options for these, what should I look for? Let's take a look. Vail does have Vail has options on it. Oh, sorry. Let me share my screen with you. So Vail has options. I've traded the Vail options before. The simplest thing, because there's not a lot of volume here. If we look at the volume column on here, if you just look at this volume right here, this is 3 days to expiration, there just really isn't any except for the very, very close to at the money positions. So especially if you were looking for very short term, like if you were swinging this and so Vail around 1563, and you were thinking that there was some sort of exit plan in place by March 6th, what I would do to increase my potential is I would look about and say, how high do I think it's going to go? So to go to the chart, when we're looking at this kind of swing, what is the expectation? Like, do we think that the stock is going to go to $18, or do we think that the stock is going to go to $17.50? Where would be the typical exit play? You can see there's been a couple of tops here at around that $16.50 level, and so, or $17.50 rather. But maybe that take profit is only at the 17. Maybe that's all I need it to go to, is just up to $17. Maybe that's enough of a position move, because getting in at 1563, if it moves up to $17, I made $1.50 per play. So if I had that assumption that it only needed to move to $17, what I could do is I could sell this 97 put that it expires March 6th. And if we look at the curve, we're going to see what the probability of profit is. Now, when we buy stock, we have about a 50% probability of profit. We have 50% chance that the stock is going to go up and the stock is going to go down, right, in price. These are the prices along this line. So this would be 1760. When we do this increases the probability of profit by a very small amount. And the reason why it increases it by such a small amount is because there's not a lot of extrinsic value in here. The extrinsic value is relatively small because a lot of people don't think it's going to go all the way up to this $17 mark over the course of the next 3 days. For this reason, using these options may not be advantageous to us, because if the stock doesn't move, we're making only a couple of pennies. Now, I was actually able to see that because I've trained myself to look at the screen. But when we look at the out of the money positions, the call, the 17 call, is only worth between 2 cents and a nickel. That's full extrinsic value when we look at out of the money options. So I know that if the 17 call has extrinsic value of 2 cents to 5 cents, then that's how much this position has. The put has only 2 cents to 5 cents in it as well, because they're at the same strike. Now, if I look at the 1650 put, or a call rather, it's got 8 cents to 12 cents. This is like a significantly bigger percentage comparatively to the price of the stock. 8 cents is 0.5%. So that means I get an extra bonus 0.5% if I sell either the 1650 call or I sell the 1650 put. So if I wanted a less aggressive position, this one will actually give me a higher probability of making money by a few pennies more. You'll see where my break even is. Even right now, the stock is at 1593. This particular position has a break even much closer to where Corey already is. Corey was able to buy at 15, what did he say? 1563. This one has a break even of 1575. So on the downside, the max loss is 1575. Corey's max loss is 1570 or 1563 per 100 shares. In this case, it still can make money, but it gets capped out at 1650. So the most amount of money that we can make on 100 shares is 75 bucks. This is where, this is how we might trade this. Now, for somebody like Corey, he might consider doing a, buying a put below as well. And this would operate as like a stop loss, but it's a little more dynamic, which is pretty fantastic. So if you look at a position like this has kind of, I'm trying to scroll over here and make this look right. This has a similar profit loss to a profit loss chart to buying stock and having a stop loss in place. The nice thing about this type of setup is that, say the stock doesn't move up or down from this price, if it just stays here at 1594, well, if it did over the next 3 days, this trade actually makes $13. You know, and I know it's small, but the max loss on this trade is 82 bucks. So this is set up in a more similar way to the way that swing traders would typically handle stuff, where they've got a stop loss set and they have a max loss and they have a max profit of 68 bucks. And you can see we have a much higher increased probability of profit at 55% relative to how swing traders operate, which is like 50% probability of profit. And it's because of this extra extrinsic value. To get the 3-to-1 though, like if I know Corey would want like a 3-to-1. In that case, you would want to sell something further up, right? So let's, why did I get, let's not do that. Buy the 15, sell the 18. And in this case, now you see a max profit of 210, max loss of 90. But again, that probability of profit's only 50.98. So I wouldn't necessarily bother with this. The nice thing about this particular trade though is, that in the event of the market like really crashing tomorrow and then rebounding on Thursday. So say Vail just really dumps tomorrow and then bounces back up, a swing trader will get stopped out on that trade and they will have hit max loss. Whereas an option trader, it could go down and be well below, and they can actually hold through that potential recovery. So that's one of the biggest advantages to learning how to option trade. But that's as simple as I would do it. Is I would do a spread where I'm buying a put below, I'm selling a put above, and that's the whole trade. Let's look on Rig and see if we can set up something. Rig doesn't have quite as robust as options the last time I traded it. So again, we're looking at the chart, we're saying, okay, we've got an entry price of $6, which I think is an excellent entry price. We can see the range, 680, maybe $7. I'm not sure where Corey's profit target is, but if I was doing options and I wanted it just the March 6th, what I could do is I could buy this put below again. So I'm limiting my downside by purchasing that, and it's costing me $3. And then I am selling the 8 and I'm collecting $133 for that. So in this case, where's the stock trading at 609? So in this case, there's no value here. There's, again, the out of the money options on this side. None of the market makers are pricing in an upside move at this point in time. We can see that at least over the next 3 days. So it's not really costing us anything. It's just we aren't gaining an advantage, which means the probability is going to be very, very close. Probability is close to the same as buying stock, but max loss 50 bucks, max profit 196, and out of pocket cost on this. So in this case, what we would do is we would be out of pocket $200. To buy this trade in, and we would expect that say we spent 197 on it, then our break even is going to be 603, and we can calculate that break even based on the value of the put that we own or that we're short. So sorry, I'm saying cost. This is actually a credit to open this. So we receive $197 to open this trade. So there's no out-of-pocket expense to open it. We actually receive cash into our account to open this trade. We receive $197. Now, if the stock is trading at $6 on Friday, I have to buy out this 8 put. If the difference between 8 and 6 is $2, 2 times 100 is $200. So if the stock was trading at $6, I would have to pay back 200. From the 197 I collected, I would be a net loss of $3. This is, that's how you would set it up. This is similar to what a swing trader would set up with a risk to reward, risking $53 to make 196. And they actually don't have any money out of pocket to open this. They actually receive credit to open the trade. And they have that dynamic risk protection on. If you did it at later dates, then you would have a greater expectation. So if you said, like, say you wanted this over 9 days, then the probability of profit typically increases. And in this case, it actually reduces. So this is what we're looking for. We want a probability of profit that's higher than 50% because that's the risk of a swing trade. Hopefully that makes sense. Lori, you understand diagonals. That's awesome. I'm glad. Because gold and silver, IWM, we're all in a range. Yes, they have been. But have you been breaking even, or have you been making, Lori, have you been making money on those trades? Because we've been sideways for a little while. So, condors have been paying, doing directional swing trades, like when the market dips to the lower portion of that range and taking a long put structure, like I was just demonstrating on RIP and Vail. Those have been working. It's been pretty good. Shawpaw is looking at USO. Shawpaw, I haven't seen you for a while. Good to see you back. USO, I've been USO covered call 80 expires March 27th because it spiked. Is it better to roll out at the same strike and churn credit, as USO is cyclical and often comes down to usual price if the issue is resolved? This is a covered call, right? So covered call, I mean, basically you're taking max profit at the 80 March 27th. March 27th is quite a ways away. Let's look at the actual pricing on USO, because I don't know how far that is in the money. I didn't look at USO specifically this morning, but $88. I mean, that's so optimally where you want to be. If we were just to build this today, let's take a look at how much money is in it if we were to open it today, because obviously you're already profitable if you're in this position now. But having the 80 covered call, selling that, it has $2.15 in extrinsic value. So when I'm selling the in the money call, I'm looking at the put side for the extrinsic value. So these are the out of the money positions. So I can see $215 is the max profit that I would make off this from now to today, even if it dropped back down to $80. So the question becomes, how is that worth it? I'm going to add the stock in here, and then we'll get the calculator out. So if I was to buy USO today and own the shares and sell the in the money covered call, then let's look at the curve. It's definitely positive at this level. So from here, from today, the max profit is going to be that $214 that I said. So that's the extrinsic value. And we make that $214 as long as the stock stays above $80. If we look at the chart though, I know oil's going to stay pretty high here. The question is it going to stay that high? When we look at the curve, this is still a long delta play. I mean, you haven't hit max profit yet. It would have to be, in the $100 range for it to be right at max profit at this point in time. So the risk is to the downside, but the risk is only to the downside at these levels. Depending on how big the position is, I typically look to take profits on stuff like this. Like that's a move to the upside, unless that's going to trigger a tax gain, then I might not. From a perspective of how much money I have tied up, let's look at it annually. So the amount of value that it has right now is $7,790. So what is $214 return on $77.90? And then we'll look at that over the number of days. So this is a 0.27% return over 23 days. This is still an extremely good return if holding this position. So 2.7%, we're going to divide that by 23. And we're going to then times this by 365. This will give us the annualized return, simple annualized return of 43%. Any position that I'm holding that has $8 of protection in play and can make 43% annually, I'm pretty happy in a position like that. So what I would do is I would sit on this and I would wait for the market action to come down a little bit, or I would exit my positions based on the fact that I've already made a ton of money on this position. I wouldn't be looking to roll out. 23 days is great. 43% annualized is a great return for me. I'm happy on any positions that are making 43% a year. So I would, and that feels right? So if I make $200 every 3 weeks, yeah, that works out to about $4,000 a year. So yeah, that calculation's correct. We did that on the daily. I would sit on that. I like holding things like this closer to expiration, but I'm basing it on the annualized return. Once it's less annualized return, then obviously it needs to be rolled. But the extrinsic value is plenty right now. Lori says, oh, that is interesting. I sell against the longs multiple times. I do too, Lori. I do as well. But so we're going way back in the conversation about the diagonals and saying, if we sell a weekly a put and then we buy a longer dated put, I do as well. So, but what I want is to watch my theta decay, and I want to be very cognitive of that. So what I have found is that if I buy that long put, I will sell short puts against it for a period of time, and then I exit that long, and then I re-enter a new long, and I record that as a new trade. So that's how I function. I typically don't hold my longs to the very, very end unless it's a trade that's been massively tested. So there's definitely more risk in trading those longer dated positions that are over 100 days because there's a greater outlay of money. So it depends on what your risk tolerance is. But the daily gains are substantial when you have a longer dated long put that is decaying less than the short duration short puts that you're getting paid for. Do I like Amazon here? I took my Amazon position off the other day. I did like Amazon. Let me look at where it is today. It's flat today. Yeah, I took it, I can't remember what day I closed it, but I closed it not this week. So I closed it late. I think I closed it, I know exactly. I closed it Friday. I closed it Friday just before the close. I was just kind of watching the market action. It had nothing to do with my speculation that we were going to have a war outbreak. I would have adjusted more positions if I had been a little more on top of that. But just watching that action, how nicely we came up. And when we saw this top Thursday, so let me scrub into this a little bit so we can see a little bit tighter what was happening action-wise. So the Bollinger Bands were compressing. We saw a long signal happen on Amazon after this big drop. The price pushed lower, then we came up, and it wasn't quite like super specific, but we basically did a little double top here on the very short duration. So we saw this high had been hit effectively 3 times. On Friday, I just said, you know what, I'm taking this risk off. I had put it on right here, so it was a great. We made a little bit of money. It was a nice little play over that couple of days. So I definitely liked Amazon at the price that it was this morning, much better than the price now. But longer term, I think that this is a good trade. The point of control is still well above the current price. So if we scroll here, you can see the point of controls at, in the short duration, it's at 208. Oh, so it's right at the point of control now, unless we look at a longer duration. There was lots of movement up here before. So that point of control was at 221. This is again where I rely heavily on analysis from paid services because I want to know what the calculated fair market value is, not just the point of control. So when I see a fair value of 243, current price of 208, and then point of control over the last, let's just look at the 1 year chart. So everybody that's purchased over the last year, the point of control is at 220 with that fair market value at 243. Yes, I like Amazon here for a long play, but I am definitely swinging it at this point in time. I have current long exposure to the S&P 500 and the NASDAQ. So it does me a disservice to just get into these positions in too big a way, because if I do that, then I'm basically increasing my risk to the downside. I'm keeping my slope too slopey for my liking. I want trades to trade in a range. So if I have lots of S&P 500 exposure or lots of NASDAQ exposure, then I typically am not adding Amazon or Google or Microsoft unless I really see opportunity. This morning, there was definitely opportunity, but we also, have to monitor that fear gauge a little bit and see what's going to happen. So is this the only dip that we're going to have over the course? We just don't know what's going to happen news-wise this week. So I've been playing the indexes this morning. That's the bigger fish, and not trying to cherry pick those. Corey says, awesome, thanks you. Lori says, got it, thank you. Yeah, diagonals are so much fun. But if you find that you're like consistently, just Lori, I'm just speaking to you about the diagonals. If you're finding that you're not being consistent, then really look at your theta decay. The theta is what makes a diagonal work. And looking at exiting at a certain place. Like if the profit profile is above the expiration profile, we have to consider getting out of those trades. And we have to watch it very closely. Diagonals are tough in general, because great if they're entered in low volatility, but we're not getting paid very much for the shorts. So we kind of let the middle volatility range and so they've been working great over the last couple of weeks, where we've been above 17, but not in the 25 range. Once we're up in 25 VIX, too high to put them on, great to manage the ones we have on. Okay, you guys are awesome. It's 12 o'clock. I'm going to get out of here. Have a fantastic week. I'm going to see my patrons on Thursday. I will, if you haven't, my patrons, I keep saying that. Let's change Levi's talking and say Drawbridge Traders Club. I have made that recent change, so you can sign up 2 different ways, through Patreon or through WAP.com. The links are in drawbridgefinance.ca, my website down below. You can also check out that real-time chart to see those trades are not the trades as they happen. The trades happen in my Discord, but you can see the tracking of the returns, which has been fantastic. I hope you guys have an awesome week. I'll see my Drawbridge Traders Club members on Thursday and in the Discord. Let's get rich together. Take care.